All right, let's talk about something that holds up our entire financial world. Today, we're going to decode the rule book that basically earthquake-proofs our banking system, the Reserve Bank of India's Basel III framework. And trust me, this isn't just some boring compliance document. It's the actual blueprint for stability. So, whether you're a banking pro or deep in your finance studies, this one's for you. Let's dive in.
And yeah, the architect behind this entire structure is, of course, the RBI. They're the ones tasked with making sure India's whole financial system stays strong and resilient, which in turn protects our economy and, maybe most importantly, our trust in the banks we use every day.
So this really brings us to the most fundamental question, right? You put your money in the bank, but what's actually holding the bank itself up? It's not just a fancy logo or a good reputation. It's something much more real, a financial bedrock we call capital. And having enough of it is just completely non-negotiable.
To really get why these rules are so incredibly strict, you got to rewind the clock to 2008. The global financial crisis was a massive, brutal wake-up call. It showed the whole world what happens when banks don't have enough of their own skin in the game. They start taking huge, crazy risks, and when those bets inevitably go bad, guess who ends up footing the bill? Yep, the entire global economy. And that is exactly why Basel III is so critical. Its whole mission is to turn banks from shock transmitters into shock absorbers. So when a crisis hits, instead of making the panic worse, a well-capitalized bank can just soak up the losses, protect its depositors, and keep lending money to the economy. It becomes a firewall for stability, not a megaphone for chaos.
Okay, so how do we actually measure if a bank is strong enough? Well, this brings us to probably the single most important metric in this whole framework, the Capital Adequacy Ratio, or CAR for short. The easiest way to think about it, it's a bank's financial safety cushion.
In a nutshell, the CAR is just a score. It tells you how much of a bank's own money it has put aside to cover all of its risky activities. All those loans and investments. The higher that score, the thicker the cushion and the safer that bank is for absolutely everyone.
Now let's look at the actual math. Don't worry, it's a pretty simple fraction. On the top, you have the bank's own capital, that safety cushion we were just talking about. And on the bottom, you have something called risk-weighted assets. Let's dig into that bottom number first, because that's where things get really interesting. And this is a really crucial point. Not all of a bank's assets are created equal. Far from it. A loan to the government, that's about as safe as it gets. But a loan to a brand new, unproven startup? Whoa, that's way, way riskier. So the RBI makes banks assign a risk weight to every single thing they own. The riskier it is, the higher the weight, and the more of its own precious capital the bank has to hold against it.
So we've got a handle on the risk side of the equation, the denominator. Now let's jump back to the top of that fraction, eligible capital. What kind of money actually counts as part of that safety cushion? Well, it's broken down into two main buckets, or as they're officially known, tiers.
And the difference between them is like night and day. Tier 1 is what we call going concern capital. This is the really good stuff. It's designed to absorb losses while the bank is still alive and kicking, to prevent it from failing in the first place. Tier 2, on the other hand, is gone concern capital. Think of it more like a life raft. It's really only there to help protect depositors and clean up the mess after a bank has already gone under.
And even within that super important Tier 1 bucket, there's a VIP section. It's called Common Equity Tier 1, or CET1. This is the absolute gold standard of capital. We're talking about common shares and profits the bank has saved up. Basically, money with zero strings attached. It is the purest possible shock absorber. And believe me, it is the number that regulators watch like a hawk.
All right, so we've got the concepts down. But what are the actual hard numbers that the RBI requires for banks in India? This is where the theory gets very, very real. First off, on top of all the minimum requirements, the RBI adds something called the Capital Conservation Buffer. Just think of it as a mandatory rainy day fund. It's an extra 2.5% of that super high-quality CET1 capital that banks have to build up when times are good. And here's the genius part. If a bank gets into trouble and has to dip into that buffer, bam! It immediately faces restrictions on paying out big dividends and employee bonuses. It's a clever way to enforce discipline. Okay, so let's walk through these numbers because this is really the heart of it. The official minimum CET1 is 5.5%. But as you can see, you have to stack that 2.5% capital conservation buffer on top. That gets you to the most important number here.
An effective minimum CET1 of 8%. That is the real number banks have to stay above to avoid getting into trouble. And then down at the bottom, the total capital all in has to be at least 9%. Finally, it's important to know that Basel III isn't just about internal math. There's another piece of a puzzle called Pillar 3, Market Discipline. And really, it all comes down to one word: transparency. It forces banks to regularly and publicly report their capital ratios and the risks they're taking, all in a standard way. Why? So that investors, analysts, and even you can look under the hood and judge a bank's health for yourself. That public pressure is a powerful tool to keep banks safe.
I know, all these ratios and rules can feel a bit abstract. So let's run through a really simple, practical example to see why this is truly a matter of life and death for a bank. So let's meet safe bank and risky bank. On the surface, they look pretty similar. They both have 1,000 crores in loans out the door, but their foundations are totally different. Safe bank has a nice thick cushion of 120 crores of its own capital. Risky bank, though, it's skating on some seriously thin ice, with just 50 crores. Now a massive recession hits. 100 crores in loans go bad for both of them, overnight. For Safe Bank, it's a huge hit for sure, but it uses its 120 crore cushion, absorbs the loss, and it's still left with 20 crores. It's hurt, but it survives. And Risky Bank? It's completely wiped out. The 100 crore loss blows right through its tiny 50 crore cushion, leaving it insolvent. This right here is exactly what adequate capital is designed to prevent. So, for all you banking professionals and finance students watching this, what are the key things you need to take away from all of this? We've boiled it down to a 5-point checklist to keep in mind for compliance and audits.
First, CET1 is king, period. All your energy should be on building and protecting this high-quality capital. Second, you have to master your risk-weighted assets. If your risk assessment is flawed, your entire capital ratio is meaningless. Third, treat that 8% CET1 level as your absolute mandatory floor in normal times. It's not optional. Fourth, your internal capital assessment, the ICAP, it needs to be a real risk tool, not just a box-ticking exercise you do for the regulator. And finally, number 5, embrace transparency, because under Pillar 3, your bank's resilience is on full public display for everyone to see.
When you boil it all down, the RBI's Basel III framework is about so much more than rules. It's about building that solid foundation of stability, trust, and ultimately, growth. It's a system designed to protect all of us. But you know, as the financial world keeps changing with huge new risks like climate change and cyber threats coming at us, it does leave you with one big question. Are these capital rules enough to secure our future?